This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 16th. Some highlights from today's show. Japan is following China's negotiating tactics. Junk bonds are key to the next sell-off for equities. And the S&P 500, we discuss technicals. Good day, traders, and welcome to a happy Friday. It is, of course, the final day of the week. It's also OPEX, so we are going to see a little bit of the options expiry going through. And then, of course, don't forget, we do, of course, have the University of Michigan soft day today. We'll talk a little bit about that and the implications for the markets. But having a look at some of the overnight markets, again, it's a very subdued European session. We've seen this pretty much all week. We've seen a little bit of continuation in the bonds to the upside after that. Very, very weak PPI data yesterday. We've seen gold very much give back all of its gains from yesterday. And again, we've just seen that general positive theme continue in the European equity space. So it's almost a carbon copy of yesterday's European session. And of course, we are now going to the US session with the likes of OPEX as well as the Michigan data. That being said, our first topic for today is very much all about Japan, and of course Japan following the likes of China when it comes to how to negotiate with the US to get the best possible deal. And I think this is very important because if you've been watching the market rundown now for the last couple of weeks, we've been kind of banging on about three key players in this whole trade tariff situation. Of course, Japan is one of those very, very big key players, as well as the EU and China. They are the big three. Yes, fine, the UK got a deal and la-di-da, won a fantastic deal. The reality is that it doesn't really matter. Okay, the big players are Japan, the EU, and China, and ultimately that is going to determine where things go from a globalization perspective moving forward. Now, what we know China did was they applied this sort of stubbornness to the negotiating tactics, saying, well, look, our red line is you've got to remove everything and show some respect, otherwise we're not going to come to the table. And ultimately the US showed exactly that. They showed respect. They removed all the retaliatory tariffs and pretty much reverted to a 30% tariff, which is 10% like everyone else has got, as well as a 20% because of the ongoing fentanyl situation. So China got the best possible deal, and all they had to do was simply just let the markets force the hand of the US sort of presidency. And I think that is what Japan's looking to do. We know South Korea is looking to do that. And no doubt the EU is going to do the exact same thing, which is run the clock down to 8th of July when that 90-day sort of clock runs out, and then effectively just force the deal out of the US, force them to come to the negotiating tables by simply just watching the stock market sell off, watching bond yields rise. Okay. Now, there's some key things to take away, and I think you've got to learn to read between the lines, but this key line here where they say officials said a deal is now unlikely to be reached before elections. This is very important because those elections are going to take place ultimately at the end of July. Okay, now we know 8th of July is the D-Day for the 90-day, which means Japan's in absolutely no rush here. Okay, it's almost like they're going to let the 90-day expiry happen, perhaps let the market start to put a little bit of risk off as a result of these higher yields. But Japan has effectively said our red line is quite simple. Okay, at the end of the day, we are not going to negotiate until you remove that 25% on imports of Japanese cars. Okay, so they've stated the absolute red line. They've said our starting position remains the elimination of all these US tariffs, including a 25% on automotive, steel and aluminum. In other words, it's carbon copy China. China said, show us respect, remove it all, and then we'll talk. Japan saying, we're not going to talk until you remove all of that, then we'll start talking. Okay, it's a playbook from the China, and I expect you are going to see, as we get towards the end of June, you are going to see a little bit of risk off start to come into markets because it's that uncertainty creeping up about what comes next. But ultimately, Japan's doing the same thing. Now, what does that mean? Well, it means EU is going to do the same thing. It means South Korea is going to do the same thing. They're all going to run the clock down and force ultimately the presidency of the US to give them better, stronger deals. Okay? Now, in terms of ultimately what that means for markets, it does mean we're going to stay in this subdued environment, in this uncertain environment for an extended period of time. Okay, I think that is the case that we can expect now. This is not something that's going to be resolved this year. It's something that's perhaps going to be with us for the entire Trump presidency. Now, with that in mind, before we move on, of course, to topic number 2, I've got some very, very exciting news. We have just launched the new Tradelo.com website. It's a fantastic effort from from the team at Tradelo. In just a couple of months' time, we will of course be launching the full web application. It's a brand new web application that includes automated risk management, trade journaling, data analytics, premium trading education, a full trading community, leaderboards, all those sorts of things, and of course a trader funding program. So it's a wonderful application, a wonderful product. Go and have a look, www.tradelo.com. Have a look around, make sure you sign up so that you are notified when that launches. Now let's turn back, of course, to our topic number 2, which is this idea of the US is poised to dial back bank rules imposed in 2008 crisis. Now, we kind of have to take a look back and go back to 2008. What happened? Well, we know that there was too much leverage in the system and pretty much everything blew up. As a result, in 2014, with the Dodd-Frank, we had the SLR, or a ratio imposed on banks where they have to hold a certain percentage of capital against what they have on their balance sheet. So in a very, very basic sense, think of it as and again, it's not 3% for everyone. Of course, there's slightly different rules depending on the institution. But think of it as 3% of all your capital needs to be held, or you need to hold 3% of capital against what's on your balance sheet in the form of assets. Okay, so the more assets you have on your balance sheet as a bank, the more capital you need to put in the form of cash, in the form of equity, etc., etc. Now, this was done to somewhat disincentivize over leveraging. Okay, in other words, it kind of puts a cap on how much exposure the bank can take, how much leverage they can have, because the more leverage they have, the more capital they have to stump up. Okay, now that was put in place, of course, because of the 08 crisis. It came into place in 2014, and now the Trump administration is rolling that back. They want to roll that back. They want to allow a little bit more a capability, or the banks to be able to borrow more, lend more, do more activity in the money market. So effectively, they're kind of giving more room for banks to maneuver. Now, again, you got to go through this article. It is in the Financial Times. I think the key takeaway and the key thing to understand is, what are the implications? Why did this come about, and what are the implications for general markets? Because there will be significant implications for markets. Okay, but the key thing is when they reduce it. Okay, the general line of thinking is Scott Besson is leading us, as well as Powell is leading us to this idea that there will be a relaxation, and ultimately what it'll allow banks to do is, for one, buy more treasuries. Okay, because now they've got this extra ability to effectively have more assets on their balance sheet. That's what it is. Okay, you lower the SLR, you've got more ability to add assets to your balance sheet. So one of the key things they'll do, of course, is add bonds. Okay, they can earn interest and relatively safe interest with that sort of extra leverage. They can also expand their lending. Okay, so to the real economy, there'll be more lending ultimately. That should drive some growth. They can increase their trading and inventory positions. Okay, so they can provide better market making. They can support the repo markets. And ultimately, in general, they can just do more market making. They can make more markets. There's more activity. Okay, now very much this is a form of, let's call it the right thing. It's not necessarily a form of QE. It's a form of a bank being able to support the bond market, and banks ultimately being able to expand their balance sheets in terms of how much assets they own. Okay, so yes, the general thinking, the way to think about this is it's quite stimulatory in every way. It's stimulatory for the equity market, it's stimulatory for the bond market, it's stimulatory for the economy. Okay, and this is kind of why Trump is hell-bent on it. What he wants to do is drive yields lower, drive more activity in the economy, give banks a little bit more freedom to take on more leverage. That's the general line of thinking. Now, whether you agree or disagree is mostly irrelevant. What's important is, what are the implications for the markets in general? Now, to look at this, we've got to go back to 2020. This is the first time that was relaxed. The SLR ratio was relaxed post 2014. And the key thing to understand here is that typically it gets used as a tool more than anything. Okay, so in times of crisis, when there's not enough liquidity in the system, when obviously the central banks are about to pump a whole bunch of QE and bonds into the market, ultimately they need the banks to be able to absorb it. Okay, now they can't say to the banks, hey, absorb all this onto your balance sheet, but not release or reduce, of course, the SLR. So what happened in 2020 is they did exactly that. They removed this restriction, and it's done very much to ensure sufficient or ample liquidity in the system that can be absorbed in the form of reserves. Okay, so all you have to understand in this at a basic sense is when this gets lowered, it's going to add an additional shock absorber to the markets. Okay, because you've now got a natural buyer in the market that can buy a lot more than what they previously could. Okay, it's not like they're going to rush out and buy equities. It's not like they're going to rush out and buy US bonds. Yes, there will be some additional support for the bond markets, but it's not something that fundamentally you're going to suddenly see 10-year yields go from 5% to 4%. Okay, it's not that straightforward, but it does add an additional shock absorber to the market. Okay, and that's the key thing to understand with regards to the reduction in the SLR. Now, the junk bonds are posting a very interesting chart. Look, I think the key takeaway from the likes of the junk bonds is that it very much since 2022, you can see they've been in this, let's call it what it is, a flag. Okay. Now the junk bonds are always interesting to watch because they do reflect the real economy a hell of a lot better than general bonds or equity markets. Okay. They, there's this sort of adage of, the stock market is not the economy, and it's so true, particularly in the modern era now where tech stocks, dominate most of the indices. The point is that the junk bond index is going to reflect the real economy a lot better. In other words, it's a much better leading indicator of a recession. You're going to see a recession, you're going to see the junk bonds first. That's why we observe the chart. Now, what we can see is that junk bonds ultimately are lagging. Okay, we know that NASDAQ, we know that S&P, they're all above that 200 moving average. But we know this junk bonds is very much in a bearish flag. Okay, we've made that sort of higher low now. We're making that flag type formation. The point is that the fact that these junk bonds are not recovering, the fact that we're not even at the 2024 highs, that does suggest that we remain in the doldrums. Okay, junk bonds are going to remain weak until such a point that we either get a significant fiscal spending stimulus, or the economy starts to significantly re-accelerate, or the central bank begins to cut rates. Okay, and I think that's the key one. Junk bonds are most sensitive, of course, to the Fed and the Fed policy rate. And given where interest rates are at 4.33, and the fact that we're unlikely to see cuts until much later this year, this market is going to stay very much vulnerable to the downside. Now, like I said, I think very importantly, if you look at the junk bonds the last two sessions, they actually did top out and start to move back lower. Okay, so keep a very close eye on how junk bonds trade today, and particularly Monday, because they will lead the equity indices lower. If we start to see those junk bonds move a little bit lower as a result of what we're seeing in bond yields in general. Okay, right now this week, of course, we retraced a lot of the bond yield move post the PPI data. But if you start to see the bonds sell off again at some point next week, don't be surprised to see junk bonds leading to the downside, and that will eventually pull the equities down with it. Okay, junk bonds will typically give you a couple of days head start, a lean as to we're about to now see the equities rotate a little bit lower. So keep an eye on that, of course, into next week. Now, the S&P 500 weekly chart's a good one to look at, simply because it's just strong. We, of course, gapped up this week. We've held that gap, and we've now, of course, penetrated above the 5,900 that we've been talking about. I think today's going to be interesting. Watch the close today. We, of course, do have OPEX, so we've got that natural hedging support that's going to drop away from the equity market today. So watch how the equities trade today. Okay, wouldn't shock me if we get a little bit of a repeat of what we had back in the previous March OPEX, where we did have suddenly a significant sell-off the moment the OPEX rolled through. So keep a close eye on it. I genuinely think today, as that hedging flow disappears, as we enter that sort of window of weakness, as I say, don't be surprised to see equities have a little bit of an easier offer. That said, we got to follow the price. We closed on the pretty much the highs yesterday, and nothing really suggests in the tape that you want to be blindly shorting it. So it's very much a case of, if we do see that weakness come in today, we do close below 5,900 today, we come into Monday, I do expect we're probably going to go and fill that gap pretty quickly over the course of next week. That being said, we said earlier in the daily earlier this week about the pain trade. Of course, it's always higher. Why? Because the retail market is the one that bought this. The big money market or the big players, the big institutions, they're sitting very much in cash. And ultimately, should we continue higher next week above that 6,000 level, the pain trade is very much going to start to be felt, as everyone's going to have to chase this rally. They're going to have to get out of cash, get into this rally, because they're all talking about this sort of idea of double-digit potential returns. Okay, so watch very closely. I think today's going to be a very important clue and very important for us as day traders is that I expect we're going to find out over the next 5 days whether or not this is a dead cat bounce or whether or not we're going to record highs. In other words, I think you will know by the end of next week whether or not this is going back to take out those highs or whether or not this is now the top and we're going to rotate lower for that move back down towards the March lows. Okay, and then finally, I missed this chart yesterday. I actually wanted to show it, but I'm going to show it today because it's an interesting fundamental one. I just wanted to show the PPI. This is what it is. It's the PPI in the orange. And what I wanted to showcase to you was how far behind the Fed was ultimately in the previous hiking cycle, and ultimately also just remind you that they can get behind as well when it comes to the cutting cycle. Okay, so what I want to point your attention to is COVID, of course, happened in March, or January, February, March of 2020. So right where this red line is, that was COVID. Okay, we see that PPI fell off very aggressively as, of course, everything shut down and the world was ending. We then fast forward to the beginning of 2021, and we can really see that PPI was trading around that 4%. So levels that are typically associated with much higher inflation prints. Okay, so well above what the Fed would have been wanting to see. Now cast your mind back to when the first Fed rate hike came in. It only came in 12 months later, despite the fact of PPI absolutely rushing up the page towards 10%. Okay, and this was why the Fed made such an absolute blunder. They kept sitting in this scenario saying it's transitory, it's transitory, it's transitory, it'll just fall away all on its own like magic. Eventually they were forced to hike 25, then 50, then 75, 75, 75, and of course play catch up. Now why am I mentioning this? Well, because yesterday we saw a very weak print again. Okay, now again, there is this general line of thinking that inflation is going to ramp up over the course of the next couple of months as the tariffs start to take effect. But the reality is we've now seen very, very weak PPI prints and very weak CPI prints. Okay, so keep a close eye on the PPI. It's typically a leading indicator. It leads, and it's probably a better indicator than the CPI because typically what will happen is businesses will pull back first when a recession bites or when they're laying off. And so you'll typically see it in the PPI before you see it in the CPI. Okay, so just keep a close eye on the PPI and just keep in mind that central bankers, whilst they are super intelligent, they do make mistakes. They've made plenty of mistakes, as we can see, of course, from the COVID era. With that in mind then, let's wrap up. It is a Friday. It is one of those days where we could see just another grindy type session that we've seen pretty much all week in the equities. There's nothing to suggest that the world is going to end today. So it is one of those sessions where I suspect you're probably going to have to take your chances. You're going to have to pick a spot, take a trade, make some bucks, and then sit out and of course get to some of the weekend activities. We do have some ongoing talks between the Russians and the Ukrainians, first time since 22, which is quite symbolic and hopefully positive as we can move forward towards some form of peace deal. Don't forget we have of course got those Michigan data. It's soft data. We know fine well now that the link between the soft data and of course the hard data is very, very weak. However, we are of course seeing inflation break-evens rally up the page at the moment. So should we see another hot inflation print, don't be surprised to see a little bit of initial volatility, which then of course fades away. All right, that's a wrap for today. If there are any other questions, do post them in the Discord channel. Otherwise, good luck out there, manage the risk, go make some money.